Division 296, you're probably aware of what that means now. This legislation, as it affects super balances over $3 million, caused a lot of controversy. So it's also prompting investors perhaps to rethink how they invest. Alan Greenstein is the Chief Executive and Co-founder of Zagga, and he joins us now. Alan, welcome back. Good to see you.
Thank you, Andrew. Thanks for having me.
So, look, it looks as though this is going to get across the line in its current form. So, obviously, the controversy over this is that as it applies to those super balances over $3 million, it's not indexed and it's on unrealised gains. What is the effect and how are investors responding?
Yeah, so in simple terms, the effect is that if you're a self-managed super fund investor, and the latest stats are there are about 650,000 of those in Australia today, and if the balances in your super fund are over $3 million, and stats are that there are about 65,000 to 80,000 SMSFs with balances over $3 million, it means that that balance is going to be taxed at an extra 15%. As you have just mentioned, the difficulty with that is that 15% could be just in the form of an unrealized gain, so a mark-to-market gain on some equity, and there is no reciprocation for if that gain reverses in the following year. You don't get the return, you don't get the claim back. And the second thing is that, as you said, it's not indexed, which means that as inflation grows, that 3 million could change. So obviously for self-managed super fund investors, they're now really worried that they're going to pay 30% tax instead of 15% tax on balances that are over $3 million. And they're thinking about how do they now address that challenge.
Those, including the Treasurer, so look, this is only affecting the very wealthy in Australia. You mentioned perhaps like at this point, like some 60,000 plus that are likely to be affected. So are there broader implications?
Look, I'm not a politician, I'm not a lawyer, I'm not an accountant, I'm not a financial advisor. But as somebody who runs an investment business, I would say to you that it becomes difficult when you start getting into the area of tax on unrealized gains, because if you start with self-managed super funds, where does it end? And it's generally considered, I would say, to be bad tax policy to tax unrealized gains. It doesn't happen generally in other countries in the world. And I think that from an external point of view, those investors who are looking at Australia as an investment, as a safe haven for their investments, would be justifiably concerned if we're going to start bringing in tax legislation which makes the tax on gains unpredictable going forward.
All right, you're worried it's going to be a slippery slope.
Yes.
What then are investors doing, those that are affected most immediately then? Where are they shifting to?
I think the obvious answer, I have my own self-managed super fund, and the obvious solution for me is to start thinking about assets in there that are not going to be subject to capital gain. So obviously anything that is not an equity or anything that is not an underlying asset which could be subject to value. That brings us to alternative investment products. It brings us to something like private credit as the obvious one, because when you're investing in private credit, the amount of money that you invest is not subject to capital gain. You're not going to get an uptick on the $1 million you put into the loan. You're going to earn an interest payment or a distribution on that. Now, obviously, to the extent that that interest payment or distribution ticks you over the 3 million balance, yes, you will pay the extra tax, but it is not an unrealized gain, it's a realized gain, so you would expect that anyway. But more importantly, it's not as if you're putting in $1 million and earning a 8% return, and that $1 million becomes now $1.2 million. So you've had a 20% uptick on the capital plus the 8% return. You're dealing only with the distribution. That distribution is therefore going to neutralize the unrealized gain component. And I think that a lot of SMSF investors are looking at now deploying into assets where they will not be subject to capital gains.
All right. Hence, perhaps the move to private credit, it has become more and more attractive to many. Its growth here has been very rapid, certainly in the past year or two. Specifically, where would you be looking for in private credit?
Look, I've got to talk to my own book. We like secured credit and we like real estate credit specifically. Let's just accept that there are all kinds of private credit. There's consumer, there's corporate, there's secured, there's unsecured, there's blended, there are things in the middle. We like real estate private credit specifically for an investor who's looking for a transparent, consistent yield on their investment. And the reason we like it is because you're effectively funding into a shortage. We have a shortage of homes in Australia that's predicted to be around 250,000 homes by 2028. We have increasing population. Our population has increased by 600,000 people net per annum over the last couple of years. The banks are not as much in the sector as they were. They're still 82% of the sector, but they've pulled back a bit because of regulatory concerns. So we would go into that sector because the likelihood of you taking a severe knock, provided you're working with an investment manager who knows what they're doing, an asset that is going to hold its value, and you've done your DD, the likelihood is that that investment is going to deliver you a predictable, consistent, safe return.
What are the potential risks you need to consider, certainly as far as the lack of liquidity is concerned?
Absolutely. Lack of liquidity is an issue when it comes to these things, but I think liquidity is a bit of a misnomer. I mean, you do get liquidity in equities, but you also take the risk that the price that you went in at is not the price you're getting out from a liquidity point of view. Liquidity often comes with a discount. In private credit, the illiquidity comes with a premium. So yes, if this is an investment on which you need your money tomorrow, you shouldn't be in it necessarily. But if it is a self-managed super fund investment and you don't need to deploy those assets anywhere, and in any event you only have limited places in which you can deploy them, then the illiquidity of private credit should not really be as big an issue and should be offset by the assuredness of the distribution and the interest that you're going to be paid. I think the biggest risk about private credit today, and you've alluded to it, it seems to be the hottest topic on the block. There are very, very many players in the market, and I think that any investor needs to be very circumspect about who they give their money to manage and the kinds of assets those are being deployed in. That, to my mind, is the biggest risk. Select the right manager.